It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets. And it took them 24 days to go bankrupt.
Just an immediate sense of outrage at Lay and Skilling and Fastow when people realized how much they had profited and how completely artificial the appearance of this company had been.
That nobody could really understand, and in fact that many of Ken Lay's lieutenants questioned. They said this business can't be making this much money legitimately. Something weird is going on.
Mark-to-market accounting allowed Enron to book potential future profits on the very day a deal was signed. No matter how little cash actually came in the door, to the outside world, Enron's profits could be whatever Enron said they were.
Things that fascinated me was that almost all of the Wall Street analysts who covered Enron had buy ratings or strong buy ratings on the company's stock.
One analyst who didn't buy the company line became an enemy of Enron. Enron's CFO, Andy Fastow, had his eye on John Olson, one of the only analysts skeptical of the Enron story.
Enron loved analyst strong buy recommendations.
Merrill was informed by Fastow, either you get somebody who is on board with us and has a strong buy recommendation and loves us at the same time, or we don't do any business with you.
Merrill Lynch fired John Olson. Soon after, Fastow rewarded the bank with 2 investment banking jobs worth $50 million. His job was to cover up the fact that Enron was becoming a financial fantasy land. To please the boss, Fastow had to figure out a way to keep the stock price up by hiding the fact that Enron was $30 billion in debt. Enron was just stashing its debt in Fastow's companies where investors couldn't see it. LJM was Fastow's most ambitious creation. It would work magic for Enron, and it would allow Fastow to conjure $45 million for himself. Returns that would exceed 2,000%. 96 individual bankers invested in LJM, and America's major banks put up as much as $25 million each.
The Enron fraud is the story of synergistic corruption. There are supposed to be checks and balances in the system. The lawyers are supposed to say no. The accountants are supposed to say no. The bankers are supposed to say no, but no one who was supposed to say no said no. They all took their share of the money from the fraud and put it in their pockets.
Enron paid its advisors well. In 2001, the accounting firm Arthur Andersen received $1 million a week. Enron's law firm, Vinson & Elkins, did nearly as well.
Oh, for instance, one email I remember where the banker writes, Enron loves these deals. They produce cash, but they don't have to show the debt on the balance sheet. Now, a high school student can figure out that the banks were all knowing participants in this wrongdoing.
Merrill Lynch assisted Enron in cooking its books by pretending to purchase an existing Enron asset when it was really engaged in a loan.
California was selected by Enron as the prime place to experiment with this new concept of deregulated electricity.
Commodity that normally trades in the $35 to $45 range, high prices are when it gets in the 50s or $1,000.
Prices aren't going to stay at $1,000 forever. It weeds out the weak people in the market, you know. Get rid of them, and you know what? The people who are strong will stick around.
Traders soon discovered that by shutting down power plants, they could create artificial shortages that would push prices.
Guys to get a little creative,
okay,
and come up with a reason to go down.
Like a forced outage type thing.
Right.
West Coast traders made nearly $2 billion for Enron.
The difference is between the state of California and the Titanic. At least when the Titanic went down, the lights were on.
In 2001, less than 4 months after Skilling's resignation, Enron declared bankruptcy. His accounting firm, Arthur Andersen, had begun destroying its Enron files. Enron's accounting firm, Arthur Andersen, was convicted of obstructing justice. With its reputation for honesty destroyed, America's oldest accounting firm fell along with Enron, and 29,000 people lost their jobs.
Enron, the story of unbridled greed. In 1985, Ken Lay became the chairman of Enron and saw the future in the natural gas and oil industry. He was a strong advocate for deregulation of the industries, promoting an open market system where prices could fluctuate based on the principles of supply and demand. He aligned himself with key political figures such as the Bush administration and pushed for deregulation in the early 1990s. Commodities such as natural gas and electricity were now trading on the open markets of Wall Street. Lay, with the help of his new CEO, Jeff Skilling, quickly realized that they could make more money from trading stocks in the commodities than they could by actually providing the services for the natural resources. Jeff Skilling laid the groundwork for a fraud of epic proportion by implementing a new accounting technique called mark-to-market. The technique allowed Enron to realize profits today on the speculated future prices of contracts that they held as a service provider. Enron was losing billions of dollars in expanding its energy services, but its stock prices kept going up, mainly due to the mark-to-market accounting. Andy Fastow, Enron's CFO, was in charge of meeting the company's financial targets each quarter by any means necessary. Enron violated ethical codes in favor of their unbridled greed for personal wealth. They failed to rank the interest of both shareholders and stakeholders alike. This project examines how conflicts of interest in Enron, along with the greed of top executives, led to the demise of the seventh largest company in America and almost took the entire U.S. financial market with it.
One of the unethical processes that Enron suffered from was putting short-term profits over everything else, including basic ethics. An ethical company will analyze the impact future decisions will have on shareholders and stakeholders alike. Enron did not have these concerns. As Enron grew, they relied more and more on risky short-term ventures to bring in profit and push up the stock price. This included investing in risky futures markets, abusing the accounting practice known as mark-to-market, and exploiting the energy markets to make profits at the end of quarters. The futures market can be a very risky place to put capital. When Enron lost money in these markets, they actively tried to hide the losses in order to keep the stock price up. Enron practiced in mark-to-market accounting. This allowed them to show earnings from future profits that had yet to be collected. They ended up abusing the system by marking losses as profit. The financial journal Investopia had this to say about the Enron's mark-to-market accounting practice. This type of accounting created the attitude the company did not need profits, and that by using the mark-to-market method, Enron could basically write off any losses without hurting the company's bottom line. Enron also exploited the California markets in order to make short-term profits. They practiced in deliberately increasing congestions of the electrical grid and driving prices per kilowatt hour from $40 upwards to $700 per kilowatt hour. By putting short-term profits above everything else, Enron had built a house of cards that was unstable in the long term. Modern firms need to recognize that long-term success relies not only to be accountable to shareholders, but also strategically responsible to stakeholders as well. Firms should adopt a stakeholder accountability-oriented governance process to help avoid unethical profits over people mindset that Enron had. As we see here, this is the stakeholder accountability-oriented governance process. The board of directors is not only looking out for shareholders, but also stakeholders. And ethical officers and whistleblowers are also brought into the process to make sure the company is making ethical decisions at all times. By abiding by this model, we can build a long-term healthy relationship with shareholders and stakeholders alike.
Misinterpreting public expectations. In this section, we're going to cover just some different issues that Enron was having and that they were showing the public when, in all honesty, they were lying. So the first one that we're going to go over is Enron's spokesman. They were really avid about letting the public know about like the good, only the good of what the company was doing and what was happening within the company. But the truth behind that is that the spokesmen were lacking on telling the public the true hard facts of what was actually happening within Enron. And we will get further into that within this section. Another issue is that Enron was making their books look good by showing that they were paying their employees the right amounts and everything was, it was going good. It was going to the proper people. The truth about that one is that although Enron was showing the public that they knew how to handle their books, in reality it was going into secret accounts that upper management had set aside. So, a random, $21,000 is going into, John Doe's account, when it really should have just probably stayed in the company's checking account. Another issue is the stock price. It just continued to go up and up and up every quarter. And the truth behind that one is that, yes, their financial books showed money was continually coming into the company without any trouble, but the reality of that is that Enron was loaning with other companies to get them by quarter. They would, let's say they went in with like GE or any other company for that matter. They went in with GE because, GE is a great company to go into. So GE would give them, a loan that, was to be paid back within 6 months. Well, in the end, they would never pay that back. But that money went into their account for that quarter to make sure that, their stock price would go up. It wouldn't go down. Another issue was that although the public was seeing money coming into their accounts, they didn't know the reality behind Enron, and that they were $30 billion in debt, and that they were not resurfacing anytime soon. In Enron, the truth behind, the $30 billion debt is that they had created these special accounts with like Citibank and JP Morgan Chase that would show that the fees for those accounts at Citi and Chase were being paid. However, it didn't show that they were still in debt. It showed that they were making their fee payments on time, whatever the monthly service charges for an account there, and that was being paid, but nothing else was being paid. They weren't paying off their $30 billion in debt. They weren't, they weren't making their payments, and the public didn't realize that until, toward the end of the company's highest point. Another issue was that Enron was still telling all their stockholders and shareholders that there's nothing wrong. There's nothing wrong with their company. Everything's fine. We're buying into this company on the West Coast. We got this going on and this and this. But, but it wasn't. It wasn't. Scott. You weren't. They weren't on cloud nine. And there's at a press conference telling everyone this when, you got their auditing team shredding all of their accounting information. They were hiding something. So clearly this company was in trouble, but they didn't want the public to know. And, in 1999, in their third quarter, their stock had plummeted, and in the day before, you have Schilling coming in and making this huge stock withdrawal. He bought out all of the stock. He knew that this was happening. He knew that the next day his own stock was going to be worth nothing. And so in quarter 3 in 1999, that was the first time that Enron would not be meeting their earnings since 1997. So, I mean, with them not meeting their earnings, automatically their stock went down. So, I mean, overall, I mean, these are just a few misinterpreting public expectations. But the solution to this issue really isn't a formula. There's no chart to this, like there was with the short-sighted downfalls. With this one, you just got to be able to read the signs of a company. You have to be, you just have to realize that, being able to pick up on those little things that, that just don't seem right. Like if a company is never going down in stock, I mean, it's normal for companies to fluctuate, a few cents here and there every day. I mean, but for them to, we've seen this before, like before the 1930s stock market crash, companies kept going up and up, but in the 90s and 2000s, it just isn't ideal for stock to do that. So next you're going to hear about the conflicts of interest.
Enron and its top executives committed ethical violations at all levels. I'll examine how their conflicts of interest led to the company's ultimate demise. As long as Andy Fastow and Enron met its numbers financially, the stock price kept going up. Fastow formed his own limited liability corporation specifically to do business with Enron, such as LJM1 and LJM2. He moved debt from Enron's financial sheet to the subsidies that he owned with the guarantees of stock options. Fastow's fiduciary duties were to Enron and to his subsidies, creating the conflict of interest. It was beneficial to Enron because they could write off debt to the subsidies, creating a greater net profit for Enron, pushing the stock prices up. As long as the stock went up, the subsidies made money on their investments by trading Enron's stock. Fastow skimmed millions of dollars as he moved money between Enron and his subsidies, also known as Raptors. Fastow also secured loans from about 95 investment banks, including the largest banks in America, by using stock options as repayment. As long as the stock flourished, no one could lose. In December of 1999, Merrill Lynch purchased 3 Nigerian power barges from Enron with the agreement that they would be bought back in 6 months. The sale basically helped Enron meet its financial targets for that quarter. Again, the end goal was to keep the stock prices high by meeting financial targets. Arthur Andersen's accountants were instrumental in defrauding the public. They were paid up to $1 million a week in consulting and auditing fees. Since the firm was consulting Enron on how to hide its debt, and they were in charge of auditing accounting statements, they could essentially cook the books. Since Fastow had secured loans with stock options, Andersen did not report them as debt on the balance sheet, making Enron appear to be very profitable. It was all smoke and mirrors. Enron was basically a house of cards. Executives bet the company on the assumption that they could maintain rising stock prices. If the prices fell, it would bring the house down, and eventually did when California price capped electricity rates. As stock prices began to slip, top executives in Enron began selling off their shares for personal gain while urging employees and the public to ride it out. Sharon Watkins would eventually blow the whistle on Enron's accounting techniques that further devalued the stock. As media attention of the scandal grew and inquiries began into the accounting techniques that had been used, Enron began to crumble as stock prices plummeted. Billions of dollars were lost in the investments in Enron stock. In 24 days, the seventh largest company in the Fortune 500 went bankrupt. As the scandal broke, Arthur Andersen shredded over a ton of financial documents relating to Enron. They were charged with obstruction of justice. The oldest accounting firm in the United States also lost its license to practice. On October 31, 2002, Fastow was indicted by a federal grand jury in Houston, Texas, on 78 counts including fraud, money laundering, and conspiracy. On January 14, 2004, he pled guilty to 2 counts of wire and securities fraud and agreed to serve a 10-year prison sentence. He also agreed to become an informant and cooperate with federal authorities in the prosecution of other former Enron executives in order to receive a reduced sentence. Ken Lay and Jeffrey Skilling alleged that they had no knowledge of Fastow's financial transactions. Fastow's testimony as part of his plea deal led to the indictment of Lay and Skilling on multiple charges of fraud and conspiracy. Skilling is currently serving a 14-year sentence. Lay died before his sentencing. For its role involving the Nigerian barges, 4 former Merrill top executives and 2 former mid-level Enron officials faced conspiracy and fraud charges. Merrill Lynch cut its own deal, firing bankers and agreeing to the outside oversight of its structured finance transactions. It also settled civil fraud charges brought by the U.S. Securities and Exchange Commission without admitting or denying fault. After Senate inquiries in the bankruptcy of Enron, the Sarbanes-Oxley Act of 2002 was enacted. The act would totally redefine the accounting profession by elimination of the conflicts of interest involved by separating consulting and auditing services provided to companies. The accountant's duties are now to protect the public interest, not the company's. The act also imposes more severe penalties for accountants caught manipulating the numbers. With collaboration at all levels throughout the Enron fraud, it only took one person, Sharon Watkins, to blow the whistle and bring down the house. This financial catastrophe could have been prevented at any step along the way if only one person exercised ethical behavior and said, "What we are doing is wrong."
In conclusion to our presentation, just want to kind of go back over of what we've talked about. Just starting out with the short-sighted downfalls. Enron, they had this, this bright goal. We're starting at A, and we want to get to B, and just further develop the company in. They kept building themselves up, and it was just kind of like a house of cards, and it's really not stable. At any point in time, they're gonna come crashing down. And by abiding by the short-sighted downfalls model, a firm can build a long-term healthy relationship with shareholders and stockholders alike, and Enron didn't follow that. In the misinterpreting public expectations, at the beginning, Enron was very genuine, and they wanted to let their public know what was going on in the company, how they were going to develop it, and just proving that we know what the heck we're doing because all of our books are right, they're and everything. But in the end, the spokesman, the books, they were all lacking, honesty. Enron, was moving money around, making sure their stock kept going up, and all their shareholders and stakeholders, they're trusting in this company that, it's a great company, their stock just keeps going up and up and up, and, it really isn't happening like that. In the conflict of interest, in the end, it really only took one person to stand out and say, hey, we're doing this wrong, and it needs to be put out there that this is wrong. And, it's going to hurt the company, but, in reality, it's what's best for the company. We can't keep frauding our customers and our other businesses that we're, joining in with, and just to make our stock go up. It's wrong. It's dishonest, and that's not what our company was about. So throughout the years of Enron, it just wasn't. They weren't up to par, and had the conflict of interest where you have people putting money into stock, and you have other companies buying in, but they aren't knowing what's really going on with Enron, and it hurt them in the long run.